On Friday, June 5th, the price of silver collapsed. It shed over 6% of its value in a matter of hours, violently breaking below the $70 threshold for the first time since March. This sudden bleed-out dragged other major assets down with it. Bitcoin plunged 5% on the day, while gold took a hit of over $140. It is tempting to look at a drop this severe and assume a major breakdown at an overseas mining operation or a failure in Eastern physical trading hubs like Shanghai. But the trigger for this massive sell-off actually originated in Washington, D.C., disguised as a routine early morning data release from the U.S. Bureau of Labor Statistics. Modern commodity pricing relies heavily on the strength of fiat currency. When specific economic data hits the wires, it initiates an invisible macroeconomic sequence that dictates exactly what your metal is worth on the open market. The first domino fell with the May employment situation summary. This chart shows the total non-farm payroll employment increase for the month. Markets projected a gain of about 85,000 jobs. Instead, the data revealed a staggering 172,000 jobs created. This resilience proves the economy is running hot, removing pressure on policymakers to lower interest rates. The Federal Reserve takes this robust jobs data as a green light. Projection quickly pivoted to indicate the Fed could maintain elevated rates, or even hike them 1 to 2 more times before the year closes out. Higher interest rates yield a higher return on cash. That institutional policy shift immediately turbocharges the strength and global appeal of the U.S. dollar. This line graph demonstrates exactly how this relationship functions. As the U.S. dollar index explodes higher following the jobs report, it exerts immense downward pressure on commodities, forcing the price of precious metals to plummet in tandem. A physical ounce of silver did not suddenly become less useful or abundant. The fiat currency used to measure it simply became overwhelmingly strong, forcing an automatic, mathematical repricing across the board. That macroeconomic shockwave explains the initial drop, but the sheer velocity of the crash requires looking at variables entirely unique to the silver market. The first is simply the calendar. Precious metals historically struggle during the summer months, but June stands alone as a notoriously hostile period for silver, a recurring seasonal drag often referred to as June gloom. This matrix highlights 27 years of historical data. You can see that silver averages a 1.7% decline in June, managing a positive return only 1/3 of the time, just 9 positive years out of 27. Add to that historical drag a sudden, drastic revision in global supply estimates released by major financial institutions. This area chart illustrates a massive reassessment by UBS. The bank abruptly revised their projected 2026 silver supply deficit down from 300 million ounces to a narrow margin of just 60 to 70 million. A surging fiat dollar, a historically hostile seasonal pattern, and rapidly evaporating supply fears combined simultaneously. Together, they created an inescapable trap that drove prices straight down. The institutional reaction to this data was swift. Major global banks began aggressively slashing their target prices for the metal. UBS and Commerce Bank issued synchronized downgrades. Analysts at UBS, citing the smaller deficit, completely abandoned their earlier $100 outlook, cutting their end-of-year target all the way down to $80. Yet, beneath these bearish short-term revisions, the long-term outlook tells a different story. Even with lowered targets, institutions like Commerce Bank maintain that valuations will climb back up toward the $90 range by the end of 2027. In periods of violent volatility, gold serves as a crucial anchor. Strategists continue to expect gold prices to trend higher, providing a heavier, stabilizing floor that prevents the broader metals market from completely collapsing. Physical metals provide a permanent hedge against the continuous, inevitable devaluation of standard fiat currency. The dollar may rally on a strong jobs report today, but over a long enough timeline, inflation persists. For those steadily accumulating these assets, a severe price drop driven by a single economic report is a rare, temporary discount. It allows informed investors to leverage a mathematical pricing anomaly to acquire more physical metal for their money.